In this module, we turn our attention to the third of the four major themes for which the IFRS conceptual framework provides guidance, namely the elements of financial statements: assets, liabilities, equity, income and expenses. Collectively, they are the very basic building blocks which facilitate the presentation of an entity's financial situation and performance. And in the course of this module, we will be focusing on how they are defined, as well as what conditions need to be satisfied if they are to be recognized. Before we take a proper look at this topic, we first need to explain one very important concept, and that is the going concern assumption. Financial statements are normally prepared on the assumption that the entity in question is a going concern. Accordingly, there is an underlying presumption that the company will continue its operations for the foreseeable future and that it has neither the intention nor the need to liquidate or reduce materially the scale of its operations. If it is the case that such an intention or need exists, the company's financial statements may have to be prepared on a different basis, and if so, the basis used must be disclosed. With that introduction over, we can now proceed to discuss the elements of financial statements, the core topic of this module. The framework mentions 5 key elements, splitting them into 2 categories: elements related to the measurement of financial position and elements related to the measurement of performance. The first category includes assets, liabilities, and equity, whereas the second comprises income and expenses. Before we go into the details of each element, let's first consider the reason why they are actually divided into 2 groups. I suggest that we draw on a very visual metaphor taken from the movie industry. The company which prepares a set of financial statements is akin to the main protagonist, the lead character of the movie. If that's the case, you can think of those 3 elements related to the measurement of financial position, that's assets, liabilities and equity, as composing a single frame, a frozen still or shot. If you pause a movie, you will see that single frame, which obviously contains lots of detail that may be interpreted and analyzed at will. However, focusing on just a single scene and its various elements does not allow you to appreciate the overall plot or even the tone or mood of the film. After all, the movie may be a happy one, whereas a particular scene may be sad. That is why, in order to really understand and appreciate what is going on, you need to look at the full sequence of scenes which make up the entire movie. As you probably suspect by now, in our film metaphor, the plot of the movie may be compared to the 2 financial statements elements which relate to performance, that is, income and expenses. In contrast to assets, liabilities or equity which present a snapshot at a single point in time, income and expenses portray the action or performance taking place over a certain period. The metaphor becomes even more accurate when you realize that the plot of a movie is nothing else than a sequence of individual frames. This is also very true of financial reporting, where a company's financial performance, as made up of income and expenses, is nothing else than a reflection of the changes in value recorded in respect of the elements related to financial position: assets, liabilities, and equity. Let's make a start on the formal introduction of the 5 financial statements elements. First up are assets, which the IFRS conceptual framework defines as resources controlled by the entity as a result of past events, from which future economic benefits are expected to flow to the entity. As you can see, assets are identified by reference to 3 crucial features, which we will now discuss one by one. For an asset to exist as an element of a company's statement of financial position, that company or entity needs to be in control of the asset, so it must have the power to dictate, for example, how the asset is deployed, who has access to it, or whether it should be sold or kept in the company. It is also worth emphasizing that although the majority of assets that are controlled by a company are also owned by that entity, legal ownership is not a prerequisite for the recognition of an asset in the statement of financial position. After all, control is not synonymous with ownership, a notion which we discuss in detail in the section of the material devoted to leasing. The next defining element of an asset, the statement that assets result from past events, is pretty straightforward. Basically, what is being said here is that for each asset reported in the statement of financial position, there must have been a past event which made the recognition of that asset possible. For example, a machine, an item of property, plant and equipment, was bought and delivered to the company. A building was constructed, a bank transfer was received, and so on. We now come to the final and most important characteristic of an asset, and that's the expectation of future economic benefits. An asset must be of value to the reporting entity, so it must be a resource which the company expects to convert into a flow of benefits of one kind or another. Imagine the microphone that I am talking into right now. It's a fragile and sensitive piece of equipment, but because I take good care of it, I expect that it will keep generating benefits for me for many years to come. So, what would happen if this microphone were to drop onto the floor? Given how sensitive it is, there is a high probability that it would break beyond repair. If that were the case, I would unfortunately lose all hope of deriving any further benefits from it, and would therefore have to stop presenting the microphone as an asset in my statement of financial position. We can now cross over to the second element related to the measurement of financial position, and that's liabilities, which, like assets, may also be defined by reference to three crucial points. According to the IFRS conceptual framework, liabilities are the entity's present obligations, arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Let's start with the second element, which, as you may have spotted already, is in fact identical to the one featuring in the definition of assets. A liability may only be recognized as a result of a past transaction or event. So, just as was the case with assets, something must have already happened. For example, a purchase was made, which has led to the recognition of a trade payable, or perhaps the company lost a case in court and has been ordered to pay compensation to a client, which will also have resulted in the recognition of a liability. The third point of the definition references the fact that the settlement of an obligation recognized as a liability typically entails giving up valuable resources. This may, for example, take the form of a transfer of cash, some other asset, or perhaps the rendering of a service, as is the case with repairs taking place under warranty agreements. Let's now examine the first component of the liability definition, namely the notion of a present obligation, that is, a duty or responsibility to act or perform in a certain way. Present obligations may actually arise in two ways. The majority are so-called legal obligations, as they result from binding contracts which are legally enforceable or from statutory requirements. The second category comprises constructive obligations, which are the result of past behavior, established practice, or business custom, such as a company's policy to replace faulty products even after the explicit warranty period has ended. In such a case, the company is no longer legally obliged to rectify faults discovered by clients, but if this is an established practice followed over many years, a constructive obligation exists. To appreciate the logic behind the final element related to the measurement of financial position, let's take a bird's eye view of the statement of financial position as a whole. On the one hand, we have assets. resources that will convert into benefits flowing to the company. On the other hand, there are liabilities, which will lead to benefits flowing out of the company. The two are typically not identical in size, so what is the difference? Well, that difference has its own name. It is referenced to as equity, which the IFRS conceptual framework defines simply as the residual interest in the assets of the entity after deducting all of its liabilities. At the very beginning of this module, we used the movie analogy to emphasize the notion that while the statement of financial position shows a snapshot of the company at a single point in time, the income statement, and more generally the statement of comprehensive income, describes a company's performance over a specified period, for example 1 year. We also listed the two elements which the IFRS conceptual framework identifies as relating to the measurement of performance, namely income and expenses. It is now time to inspect their definitions, and I suggest we look at them simultaneously as they are very much linked to one another. Income is defined as increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases in liabilities that result in increases in equity other than those relating to contributions from equity participants. On the other hand, expenses are identified as decreases in economic benefits during the accounting period in the form of outflows or reductions in assets or increases in liabilities that result in decreases in equity other than those relating to distributions to equity participants. As you will have probably spotted, the two definitions are mirror images of one another. The all-important differences manifest themselves in the swapping of terms: inflows for outflows, increases for decreases, enhancements for reductions, and finally contributions for distributions. A second point which is worth noting is that both definitions relate very closely to the concepts of assets, liabilities, and equity. This is, of course, not a coincidence. The intention of the framework is to indicate that income and expenses are a reflection of changes in the value of assets and liabilities, and as a consequence in the value of equity as well. You may recall that this notion was also part of our movie metaphor when we remarked that the plot of a film is nothing other than a sequence of individual frames. And finally, let's also note that both definitions clearly exclude the effects of contributions from and distributions to equity participants. Accordingly, a company is not able to recognize income when it receives fresh capital from shareholders, and similarly, no expense is recorded upon the payment of dividends. With the 5 core financial statements elements defined, we can now inspect what conditions need to be met for these items to actually be recognized. As you may have seen in other sections of the material, most categories of assets, liabilities, income and expenses have their own individual recognition rules as prescribed by specific standards. So, in this module, we will simply list the generic recognition conditions as provided by the framework. Let's start with assets, which should be recognized when it is probable that future economic benefits will flow to the entity and the asset can be measured reliably. On the other hand, a liability is recognized when it is probable that the settlement of a present obligation will result in an outflow of economic benefits, and that outflow can once again be measured reliably. You should appreciate that the framework does not provide any specific recognition criteria for equity, since it is viewed as a residual value, the arithmetic difference between the sum of recognized assets and liabilities. Moving on to the elements related to measurement of performance. Income is recognized when there has been an increase in an asset or a decrease of a liability that can be measured reliably. On the other hand, an expense is recognized when there has been a decrease of an asset or an increase in a liability that can once again be measured reliably.